Welcome to the deep dive. Today, we're jumping right into a company everyone knows, maybe thinks they know completely, Apple. Ticker AAPL, obviously.
Right. And we've got this really detailed stock analysis report dated just June 14th, 2025. It's packed with info.
Yeah, so our mission today is pretty straightforward. Unpack this analysis, pull out the most critical insights, and really help you understand what's driving Apple, its financials, its value.
And maybe more importantly, the challenges. Because this report, well, it doesn't just sing praises. It highlights a pretty complex picture.
Especially around valuation, I gather, and
Yeah.
some significant headwinds.
Exactly. There's a real tension there, a kind of paradox when you try to pin down its true value based on different methods. And yeah, some major obstacles are definitely on the horizon, according to this analysis.
Okay, paradoxes and headwinds sounds like we need to dig in. So just to set the stage, Apple, huge multinational tech company, designs, makes, sells consumer electronics, software, online services all over the world.
Yep. We all know the big products. iPhone, still the flagship, the main money maker. Then you have the Mac line, iPads, and this increasingly important category, wearables, home, and accessories.
That's the Apple Watch, AirPods, Apple TV, HomePod, that whole ecosystem creeping into our lives.
Right. And then there's the other massive piece, which this report really emphasizes, the services segment.
Yes, App Store, Apple Music, iCloud, Apple TV, plus Rabio, Apple Care, Apple Pay. The list goes on. Recurring revenue streams.
And crucially, high profit margins. The report makes it clear these services are way more profitable than selling hardware. So while hardware sales are still the bulk of the revenue,
Services are growing fast and boosting overall profitability. Got it. And the report mentions seasonality.
oh yeah, big time. Holiday season, new iPhone launches usually mean their fiscal first quarter, which is Q4 on the calendar, is typically their strongest.
Now let's talk about the Apple ecosystem, or as some call it, the walled garden. This report seems to focus on it quite a bit.
It's central to their strategy. It's how the hardware, the software iOS, macOS, and all those services just work together seamlessly.
Which creates a great user experience, sure, but strategically.
Strategically, it builds intense customer loyalty. It creates really significant switching costs. It's not just buying a new phone. It's untangling your whole digital life if you leave.
So you get locked in, basically.
Pretty much. And that sticky user base is gold for the services business, and it helps them justify those premium prices for the hardware.
Okay, so that ecosystem is key. How does Apple stack up in the market right now, according to this early 2025 data?
Well, they're consistently one of the world's largest companies by market cap, by revenue, huge influence.
And market share. In smartphones, the report says they were number 2 globally in Q1 25, around 19%.
Yep, just behind Samsung's 20.4%. But, and this is critical, Apple dominates the premium segment. They sell fewer phones overall than Samsung, which has phones at all price points.
But Apple makes way more profit per phone, capturing a disproportionate share of the industry's total profits.
Exactly. In PCs, they're further back, number 4, with about 8.7% share behind Lenovo, HP, Dell.
But tablets.
Tablets, they're number 1. Comfortably at 37.3% share, way ahead of Samsung at 18%.
And wearables. That market's exploding.
It is. Depending on how you slice it, they might be second overall, but the report confirms they're number 1 in smartwatches specifically, with around 23.8% share.
So the competitive landscape is intense. Samsung, Google, Microsoft, Huawei, Xiaomi, lots of big players across all these areas.
Absolutely. And Apple's premium focus means lower unit volume share compared to some, especially with Android being so dominant globally across price ranges. This presents, opportunities in emerging markets, maybe with cheaper models like that rumored iPhone 16.
But also risks, right, if competitors make better high-end stuff.
Definitely. And the whole consumer electronics sector is cyclical. Economic downturns hit sales of premium goods.
But that's where services come in again as a buffer.
Precisely. That recurring revenue helps smooth out the bumps from hardware sales cycles. It adds stability.
Okay, let's shift to the financials. The report uses data up to March 2025, looking back a few years. What's the big picture?
The big picture is exceptionally strong financial health, really robust fundamentals.
Revenue grew significantly from 2020, hitting over $400 billion in the 12 months ending March 2025, though growth slowed down recently.
Yeah, growth moderated to about 2% in fiscal 24, but the scale is just immense. And again, the real story within that is services.
Right, that consistent growth engine went from about $54 billion in 2020 to over $96 billion in 2024.
That's where the growth is.
Yeah.
And it's fundamentally changing their profitability profile
How so? The report mentions margins expanding.
dramatically. Gross margin went from around 38% in 2020 to over 46% in 2024. Net profit margin expanded too.
And that's directly because of services.
Directly. The report breaks it down. Services gross margin was nearly 74% in FY24. Compare that to products gross margin around 37%. As services become a bigger piece of the revenue mix, the overall company margin just gets pulled higher.
Makes sense. And cash flow.
Staggering amounts. Free cash flow, the cash left after running the business and investing in assets, was around $109 billion in FY24.
Wow. Okay. And that cash lets them do what?
Fund massive R&D, make acquisitions, and return huge amounts to shareholders through dividends and buybacks. So yeah, financials look great, high margins, tons of cash.
All right. So financially strong, dominant, premium player, sticky ecosystem.
Yeah.
Seems straightforward, but here's where you said the paradox comes in. Valuing this company.
This is the core conflict highlighted in the report. How do you put a price on all that?
Yeah.
They looked at it two main ways, and the answers are, well, very different.
Okay. Method one.
Method one, discounted cash flow. DCF. This is the classic finance approach. Project future cash flows, discount them back to today's value based on risk and the time value of money. It aims for an intrinsic value.
And the report's DCF model used specific assumptions.
Yeah, key ones were a weighted average cost of capital, or WACC, of 9.25%, a terminal growth rate of 2.5%, an average free cash flow margin assumption of 25%, and specific revenue growth forecasts that decline over time. Pretty standard inputs, though debatable, of course.
And the result. The intrinsic value per share from this DCF.
Approximately $104.60 per share.
Whoa. Okay, wait. $104.60. The report mentioned the stock was trading around $199 in mid-June 2025.
Exactly. So this fundamental cash flow-based valuation suggests the stock is worth like half its market price. That's a massive gap.
That's stark. Does the report explain that?
Well, it emphasizes how sensitive DCF models are. Tweak the WACC by 1%, change the growth rate assumption even slightly, and that $104 figure can jump or fall quite a bit. But based on these assumptions, which seem reasonably conservative, the fundamental value looks much lower than where the market has it priced.
Okay, so method two must tell a different story. Relative valuation.
Right, this is much simpler. You just look at Apple's market multiples like price to earnings, price to sales, and compare them to similar companies or industry averages.
What were Apple's multiples around that time?
For the trailing 12 months ending March 2025, PE ratio around 30.9x, price to sales about 7.5x, EV to EBITDA around 21.2x, and a price to book ratio that's really high, over 45x.
And compared to peers like Samsung or Google or the industry,
Apple consistently trades at a significant premium on pretty much all these metrics, especially price to sales and that very high price to book.
so here it is, the aha moment. DCF says maybe $105. Market multiples say investors are paying way, way more relative to earnings, sales, book value than for comparable companies.
That's the juxtaposition the report lays out so clearly.
So why? Why is the market paying this huge premium that the fundamental DCF doesn't seem to support?
That's the core insight. The market isn't just looking at the current cash flow generation discounted back. It's pricing in a whole lot more. It's reflecting enormous investor confidence in
the ecosystem.
exactly the power of the brand, that incredibly sticky ecosystem we talked about, the track record of innovation, their proprietary silicon like the M-series chips, their retail network.
And crucially, high expectations for future growth. Things that conservative DCF might underweight, like AI, AR/VR.
Precisely. The market seems to be betting heavily on Apple's ability to innovate, to leverage its intangible assets, and to successfully execute on these new initiatives. Though the report does add a note that the high PB is partly skewed by massive share buybacks, reducing the book value denominator.
Okay, so the market sees this wide and deep economic moat and is willing to pay a premium for its perceived durability and future potential.
You got it. That moat is built on strong brand loyalty, those high switching costs from the ecosystem, the history of innovation, intangible assets like patents, their distribution network, and just sheer financial firepower.
But moats aren't invincible. What are the big risks that could challenge this? The report flags some major ones, starting with regulation.
Yes, regulatory scrutiny and antitrust litigation is highlighted as a major and escalating risk. Apple's dominance and the control it exerts over its ecosystem are really drawing fire globally.
We see headlines all the time. App Store commissions, the rules about linking out to other payment methods.
Right. The report specifically mentions the EU fine from March 2024 over 1.8 billion related to music streaming apps, and the EU's Digital Markets Act, the DMA, labeling Apple a gatekeeper with strict new rules to open things up.
But the really big one highlighted is the U.S. Department of Justice lawsuit, filed March 2024.
That's the one. The DOJ is accusing Apple of illegally monopolizing the smartphone market through its control over the iPhone ecosystem.
What are the specific complaints?
The report mentions things like degrading cross-platform messaging, the green bubble effect, limiting third-party access to the iPhone's NFC chip for payments,
Yeah.
and using contractual terms to lock in developers and users.
And the potential consequences if the DOJ wins.
The report suggests they could be severe. Forced changes to the App Store business model, maybe mandating interoperability or access to parts of the ecosystem that are currently closed off. It's a direct threat to that walled garden structure.
Wow. Okay, that sounds serious. What else? AI competition.
Yeah, another key challenge. Apple recently launched Apple Intelligence, their take on AI. But the report notes a perception that they might be playing catch-up, especially in generative AI compared to Google or Microsoft and OpenAI.
Their strategy seems focused on-device AI for privacy reasons.
Which is a potential advantage, yes, but might limit capabilities compared to cloud-based AI from competitors. And the fact they have partnered with OpenAI for ChatGPT integration, while perhaps pragmatic, could also signal gaps in their own current tech.
Okay, regulatory threats, AI competition. What about operational risks?
Big ones there, too. Heavy reliance on China is a major factor, both for manufacturing assembly, think Foxconn, and is a huge market, about 19% of sales.
Which means exposure to U.S.-China tensions, tariffs, policy shifts, potential disruptions.
All of that. They are trying to diversify manufacturing, the report notes, to places like India and Vietnam, but it's slow, complex, and costly.
And despite services growth, they still lean heavily on the iPhone, right?
Absolutely. Product concentration risk. If iPhone demand slows down market saturation, competition heating up, maybe less exciting upgrades, or just a bad economy, it hits them hard. Services cushion it, but the iPhone is usually how people enter the ecosystem in the first place.
Plus general macroeconomic risks, sensitivity to recessions for premium goods. And that high valuation itself is a risk, implies high expectations if they stumble on execution.
The stock could react poorly. And the report connects these risks. Imagine regulators forcing the ecosystem open just as Apple is trying to catch up and deeply integrate its AI. That combination could really weaken their differentiators and lower those switching costs. It's a tricky strategic moment.
Okay, quite a list of challenges. So
Yeah.
looking ahead, what are the potential positives, the catalysts that could drive the stock, according to the report?
Well, the big one is if Apple Intelligence really takes off. They aim to roll it out across basically everything by late 2025. Tim Cook called it foundational. If it drives iPhone upgrades and makes services stickier, that's huge.
What else? New product categories?
Growth in things like Future Vision Pro versions. Continued expansion of services, the report mentions, targets like a $110 billion annual run rate and 1.5 billion paid subscriptions by late 2025.
Emerging markets still a factor.
Definitely. The report noted a recent positive bump in China iPhone sales, for instance, and, of course, continued shareholder returns, dividends, buybacks, like that $100 billion authorization in May 2025. And maybe a long shot short term, but a surprisingly favorable outcome on the regulatory front would obviously help.
But weighed against those significant headwinds, the AI race, the mounting regulatory pressure, maturing hardware markets, China risks, macro uncertainty, and that demanding valuation.
Exactly. It's a balance. Immense strengths, brand, ecosystem, financial services, AI potential, but also significant challenges, competition, regulators, China, valuation risk. The outcome, especially on AI and regulation, is really uncertain over the next year or so.
Which leads us finally to the report's recommendation for Apple stock AAPL over a 12-month horizon.
Given that whole complex picture, balancing the strengths, the risks, the valuation, the recommendation is Haywaldy.
Okay, hey, Huldy, why not buy, given the strengths, or sell, given the risks?
The justification is pretty clear in the report. First, while the fundamentals are strong, the current valuation seems to already reflect much of that strength. That DCF analysis suggests limited upside purely based on fundamentals at this price level.
And the risks?
Those regulatory and AI execution risks over the next 12 months are significant and create real uncertainty. A conservative view suggests the current premium price might not fully account for the potential negative outcomes there.
So the risk-reward profile is just balanced right now.
That's the assessment. Positive catalysts exist, but they're offset by pretty substantial headwinds at this particular valuation. The recent price run-up might have already baked in a lot of the AI optimism, too.
So just to clarify, 8-hole-D means what exactly for investors?
It means the report doesn't see this as a compelling time for new money to jump in, given the risks and uncertainty relative to the price. But it's not necessarily a signal for existing long-term investors to rush out if they understand and are comfortable with those risks. It's basically saying, let's wait and see how these critical AI and regulatory factors play out. Reassessment is needed as things become clearer.
Okay, so the deep dive really surfaces this core tension. Apple, still a powerhouse, amazing strengths, but facing these huge, potentially game-changing challenges from regulators and competitors, all while trading at a premium valuation.
Precisely. It leaves you wondering how durable that premium is, how much those future promises are really worth today, especially with the regulatory storm clouds gathering.
It really forces you, the listener, to think about that gap between the fundamental DCF value and the market's high price. How much are you willing to pay for the brand, the ecosystem, the potential of AI when the foundations are being actively challenged?
It's an absolutely pivotal time for the company.
And to keep track of how this all unfolds, this clash between regulation trying to open the garden and Apple trying to make its AI and services indispensable, make sure you subscribe to the deep dive. You'll get our fastest updates on Apple and other key companies.
And maybe leave you with this thought, building on the report. If regulators succeed in prying open the walled garden, will Apple's AI and services prove compelling enough on their own outside that integrated structure to maintain its dominance? Or will opening the gates finally give competitors a real advantage? That's the big question.